CNBC. I am joined by CNBC's senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob, and happy holidays.
Happy holidays, Katie. It's we're all limping to the end of the year here. Wall Street's pretty exhausted, I can tell you that. Most people are trying to get out and have been getting out of town, although the weather is really making it difficult.
Yeah, that's true. Well, let's jump right into it. A lot of good questions this week. So first up, we've been talking a lot about this Santa Claus rally. So today's the first day of it. Can you tell us, what is the Santa Claus rally and how does it work?
Yeah, it's been around a while. It was discovered 50 years ago by Yale Hirsch, who wrote the Stock Trader's Almanac. It's still around. His son Jeff does it. But it is the tendency for the stock market to rise in the last 5 days of the trading year. And this is the first one of those last 5 and the first 2. So in the next 7 trading days, the stock market tends to rise. It's a pretty good indicator. Actually, it does work. It tends to go up about 1.3%. That is statistically a rather large move over a 7-day period. So it's statistically significant, and it tends to go up 80% of the time. And that's pretty good. That's better than you would assume randomly on any random 7 days. So this has been around discovered 50 years ago. And one of the things about it, is it's not just a trading thing, it's an indicator. So in general, when you don't have it happen, in that 20% of the time when there is not a rally in those 7 days, the market tends to underperform in January and over the following year. It doesn't say it will be down in the following year. It doesn't say if we don't have a Santa Claus rally and we're negative in the next 7 days, we'll be down. It says generally January will underperform and the full year will underperform a typical year. It happens to be one of the ones that I actually like a lot. One reason is I knew Yale Hirsch, who's the founder of the Stock Trader's Almanac. Another is that it has some statistical validity. There's a lot of Wall Street, mythologies that are around that aren't very good statistically. This is one of the ones that's pretty good.
All right, well, we'll have to wait and see what happens there. So, Bob, another thing that we've been talking about for a while now is the hard landing versus soft landing debate. So can you tell us where Wall Street stands?
Well, it's really kind of a mess on this. Essentially, remember, I've been saying this for weeks now, 2022 is about getting your head around inflation and what's going on. 2023 is about getting your head around a recession and the extent of a recession. So there's softish landing recessions and hardish landing recessions. What's the difference? In a softish landing, the economy holds up better, simply put. Employment holds up better, housing holds up better. In a harder landing, you get much higher levels of unemployment. You get housing down much more. Consumer spending drops a lot more. The question is, to what extent is that going to happen? We're definitely going to get some kind of slowdown. The Federal Reserve wants that to combat inflation, but it's not clear what side of that it's going to actually happen. And you can see how Wall Street doesn't understand it and can't agree on it either. So, for example, most strategists think that earnings are going to be down slightly next year, and people have waffled on this. In a recession, earnings usually go down. There's another phrase that Wall Street uses called an earnings recession, which is not just does the economy go down, but do earnings go down? So the GDP might go down, 3%, pick a number. Earnings may or may not go down 3%. It may go down more than that. In a real serious recession, earnings could drop 20%. Well, that's bad. So Wall Street is trying to debate how much are earnings going to drop. You saw this week with Micron, and some of these stocks these tech stocks. We can talk about this in a minute, but they're trying to figure out what the earnings are going to look like next year. And it's really kind of a fight. So I call this cluelessness. It's not cluelessness because you're stupid. It's clueless because it's really difficult to figure out exactly how this is going to play out. We don't know. It's a lot of this depends on the course of things, even like COVID. The Russia invasion of Ukraine could change things too, if there's any movement on that front at all. And if the Fed suddenly starts singing a slightly different tune. All of these are unknowns. We don't know how to model this very well. So I call it cluelessness, and I don't mean it sound like everybody's stupid. It's just really hard to figure this out. I know people have $60 oil for next year and $120 oil. Well, that's ridiculous. You could drive a truck through that. That doesn't tell you anything. I know analysts and strategists who think the S&P is going to be at 3,600, and I know strategists think it's going to be at 4,700. That's not helpful. It's a pretty wide difference. That shows you that it's not quite clear what's going on. And sometimes you just have to accept that fact.
Yeah, there are certainly a lot of unknowns right now, but you brought up Micron and tech stocks. So let's dive in deeper there. What is happening with tech stocks right now?
Well, what's happening essentially is they're re-rating the earnings estimates downward. There are some very particular names out there, like Meta this year. Meta, basically everybody is not buying into the multiverse story that its CEO is pushing. That's a very specific stock story. Amazon also has some specific issues around retail and perhaps around a little bit of slowing on the web, around Amazon Web Services. But by and large, if you look at Micron, for example, this week, Micron is a bellwether in technology. Why? Because they make memory chips, DRAMs they're called. These memory chips are in everything. They're in cell phones, they're in PCs, they're in data centers. And so they're considered like a demand indicator. And we were hoping to hear good news on the inventory levels. So Nike, which is a separate business, makes sneakers, there was concerns about an inventory glut at Nike, particularly with China being locked down. And Nike said it was managing the inventory levels. The stock went up. People were very happy about that. Micron, again, different business, basically did not say that. They said the inventory levels were very high. They're cutting expenses. Partly they were blaming Samsung, their competitor, who's keep pushing out chips and not reducing the output. But the Wall Street basically took this as a way of saying, gee, we see some slowdowns next year potentially. And of course, it's hard to figure this out. How much is China going to reopen? That's a big question. We don't know the answer to this. How much is Europe going to recover? We don't know the answer. How big a recession is the US going to have, if at all? This is really hard questions to answer. This is an unusually clueless year. And again, not because people are stupid. So what has been happening, if you look at the SMH, which is the ETF for semiconductors, it's been going down for a few weeks now because strategists and analysts are starting to believe that the estimates for earnings for these companies are too high. And you want to look at a semiconductor capital equipment company like Applied Materials, AMAT, you can see Wall Street, believing like these are the guys who make the equipment that makes the chips. And they believe that the estimates are too high.
So Bob, switching gears a little bit here, we got this new spending bill from Congress this week, $1.7 trillion. And can you tell us, what is in there that relates to personal finance and savings?
Here's the most important thing for an average person out there, automatic enrollment in your 401k. This is one of the great innovations of the last 20 years. So, these 401ks have been around for 50 years almost. So you join a company and you have a 401k. Well, it was never automatic. They always offered it to people and you had to opt into it. And what people discovered, this is a behavioral economist thing, is that a lot of people don't opt into the 401k. There's no rational reason not to. Essentially, most companies offer matching contributions. So if you, for example, put away 5% of your savings in a 401k, many companies will match 5%. Well, a rational actor would, of course, opt in because you're getting free money. The company's offering you 5% more than you would normally make in a savings account. And yet, shockingly, a lot of people don't sign up for 401ks. Why? Well, because people are lazy, because there's a lot of financial illiteracy. It's not explained properly to people. At any rate, that's the story. So for years and years, there was a fellow named Richard Thaler, who's a behavioral economist, 20 years ago said, folks, the hell with this. Why don't we just make it compulsory, automatic enrollment? Not you have to opt in, but it's already there. And it's part of your job benefits. Now, if you want to opt out, you can do that. Nobody's going to force you to be in. And what they discovered, they revamped the law to encourage this 20 years ago. Companies that offered automatic enrollment obviously had much higher levels of enrollment, and savings rates were much higher. Well, we need to do that. We need to get people to save more because very few people get pensions anymore. Social Security, well, it gives you a little money, but not a lot. The average Social Security check is $1,400 a month. That's not going to cover it for a lot of people. It's personal savings, and people don't save enough. So how do you get people to save more? So now this law has automatic enrollment in it. You automatically are in to the plan of your company, and if you want, you can opt out. And that is a huge thing. There are some other things that are in this bill, but just that is going to dramatically increase the amount of money that's going into 401ks that is tax-free money, and it's essentially a way for people to save for their retirement, because there is a genuine retirement crisis in this country. A lot of people are going to be quite surprised they don't save enough. My generation, the baby boomers, we really screwed up. We generally did not save enough. And because of that, a lot of us have had to do some catch up and take a lot more risk. So I think this was a big week for people who are interested in improving the retirement situation of Americans.
Yeah, for sure. And I think that this example of automatic enrollment kind of really rolls in well to our next question, which is in your book that published this year, Shut Up and Keep Talking, you say that people are not always rational when it comes to investing. And so why not?
Yeah, and thanks. And the book's Shut Up and Keep Talking is out, and it's on Amazon. And it's sort of a summary of what I've learned over the last 30 years working at CNBC, and particularly the last 25 as the stocks correspondent. And one of the key chapters in the book discusses why the future is so hard to figure out, what we were just talking about. And one of the reasons it's very difficult to make predictions is that people are riddled with biases that infect their ability to make accurate predictions. What do I mean by that? There's different kinds of biases. There are cognitive biases and there are emotional biases. Emotional biases affect the way you feel. So I'll give you a few examples. People come to think that they're infallible because they did a few things right. You know, they hit a winning streak. That's called overconfidence. That is one of the most common biases. It's a mistake. It's a bias. People blindly follow what others are doing. That's called herd behavior. That's another bias. It's a mistake. People will, there's a thing called the endowment effect, where people will value something that they own a lot more than its actual market value. So you see behind me, I collect rock posters. I've told you this many times, from the 60s, Jimi Hendrix and the Doors, all that stuff. Well, what are these posters worth? They're worth, they don't have any intrinsic value. They're worth whatever anybody will pay me or anybody else in an open market for. But in an endowment effect, I believe that this poster that's behind me, this is a Led Zeppelin poster behind me, would be worth a lot more than it actually is because I own it. And somehow, just because I own it, I think it's worth more. That's an endowment effect. That's a bias. There's cognitive biases. These are emotional biases. They're just errors in reasoning. People don't know how to reason properly, so they may come to faulty conclusions about things. So people will jump to conclusions. For example, people will make a decision based on very limited evidence and not consider any other evidence. That's a mistake. People select information that supports their own point of view, and they ignore everybody else's point of view. That's called a confirmation bias. That's a really serious problem. People will give a lot more weight to recent information that they just heard of rather than information that's in the past that's just as relevant, but they don't want to think about it because they only think about what's in front of them. That's called recency bias. And I can go on and on and on. A lot is this thing called hindsight bias, where a lot of people convince themselves that they understood or predicted an event after it happened, and that leads to overconfidence in their ability to predict the future. That's called a hindsight bias. So you see what I'm saying here? There are behavioral economists have identified dozens of them, And they're in the book. I discussed them, but it's what happens is because of all of these biases, it affects your ability to make an accurate prediction, and it's a major reason why the future is so difficult to figure out. So one of the things that I talk about in the book is it is possible to get people to think more rationally. It's not hopeless. We're not like leaves blowing around in the wind. Once you identify this and realize what you're doing, you can get better at this. But I've come to the conclusion not to expect too much. And the reason is because financial illiteracy is very widespread. 30 years ago when we founded CNBC, we were all very hopeful that we were going to somehow, make the world a more rational place and everybody's going to be a more rational investor. I'm not sure the world is any better than it was 30 years ago in terms of its ability to think rationally. I've sort of given up on that. A lot of people don't really know about these biases. One of the things that did happen, though, because of behavioral economics and understanding these biases, it gave a big boost to the indexing crowd. We talk about passive investing and indexing, owning indexes rather than going out and trying to pick stocks. And this was one of the outcomes of behavioral economics. If there's so many biases out there, why should I try to go out and do things? And the stock pickers are going to have biases too. Why don't I just stay with an index? At least I will try to eliminate a lot of biases by doing that. Now, certain indexes have their own biases, of course, so don't get too complacent about that. But behavioral economics gave a very big boost to the indexing crowd overall. So just recognize the biases that you've got, and don't get too cocky and too overconfident.
Yeah, I definitely think it's helpful, like you said, just to have an awareness of these biases helps you understand your decision making a little bit more. And then, Bob, our last question, how do you sum up what happened with the stock market in 2022? And then what are you anticipating as we head into 2023?
Well, 2022 was about grappling with the after effects of COVID and the Russian invasion of Ukraine. So think of what happened with COVID. It dramatically disrupted the supply chain and affected inflation. How did it do that? Well, there was a massive increase in the money supply that was engineered by authorities in the United States, and to deal with COVID, the downturn. And the effect of that is that this greatly contributed to the inflation problem. Now, you can go screaming at the Federal Reserve all you want, but in the middle of March 2020, the world was coming to an end, folks. And they were going to do anything to just make sure the economy did not completely collapse. And they did what they had to do. And one of the effects was dramatically increasing the money supply. And that was one of the knock-on effects of that is some of this inflation problem we're dealing with right now. The effect of the Russian invasion was, look what it did. Commodity prices went crazy. The whole economy in Europe got worse. I mean, nobody predicted these two things. So this is a real, these were real black swan events that happened. 2023 is not about inflation so much. It's about the recession question that I talked about. How great is the recession going to be? It's about dealing with the after effects of all of this, of inflation, of COVID, of supply chain, of the Russia invasion. And it's really hard to get the parameters right. Like I said, I know strategists that think we're going to be at 3,600 on the S&P. We're at 3,800 now, lower. I know strategists think we're going to be 4,700. That we're gonna be up 25%. So more. So these are very wide gaps. This is what we call unusual dispersion. Normally, strategists tend to in a boring year where there's not a lot going on. Strategists and analysts tend to coalesce around a fairly small area. The stock market, the S&P typically goes up about 10% a year, not adjusted for inflation. So most strategists in a normal boring year will have estimates anywhere from like 5 to 12 or 13%, something like that. But they don't have estimates, down 10% and then another one up 25%. That's like crazy. Those are wild numbers out there. And they're not even necessarily outliers. It's not one or two crazy people. There's a lot of people who have different opinions. Again, this is a sign of cluelessness, and you have to be a little bit comfortable with uncertainty, or you're going to drive yourself crazy. A simple way to do this is just stay invested. Again, this is in the book. If you have a long-term plan, you're not trying to pick market timing, generally does not work. I know you think you're a genius. I know you think you can do it. Good luck. Go ahead. But in the book, I look at the academic evidence about this. If staying long, keeping costs low, understanding your risk tolerance, these are the classic tried and true methods and I talk about in the book and cite the experts that are out there, and the long work they have done, including Jack Bogle, the founder of Vanguard, and Jeremy Siegel, Wharton professor, dear friend of mine, he's on our air a lot. Burt Malkiel, who wrote Random Walk Down Wall Street. There's decades of very solid academic evidence about how to do long-term investing.
Well, I think that's a great note to end on. Thank you to everyone for tuning in for another year of Market Matters. Thank you, Bob, for always answering our questions, and I'll turn it over to you for any final thoughts.
And we'll be back again next year, you and I, Katie, and just remember, it was not a great year. And I'll talk next week on CNBC. We're down about 20%. It is a very, very unusual to be down 20%. And we'll talk a little bit about that. We'll talk about what happens when you're down 20% in the following years. The bottom line, I'll make it very simple, is generally back-to-back down years, very unusual. And we can talk about why. That doesn't mean it can't happen. It has happened, but it's very unusual. And we'll talk about why it's unusual and why capitalism still matters. That's, of course, the key story here. Capitalism is why the stock market keeps going up. So everybody, thank you for joining us. Have a healthy, happy, and safe New Year, and Merry Christmas and Happy Holidays.
All right. Thanks, everyone. And we'll all be tuning in to watch you on TV, Bob. So thank you all and happy holidays.
Bye.
See you next year.